Welcome to the stock market. Every single person who logs into a brokerage app faces the exact same choice: chase quick daily profits or lock your money away to let it grow over years. It looks like one giant ecosystem, but you're actually looking at two completely different financial games being played on the exact same field. To figure out which game you should be playing, you have to measure two things: how much time you have and how much daily stress you can handle. On this chart, the horizontal axis tracks time horizon, and the vertical axis measures daily stress. Investing sits in the bottom right corner, taking decades with almost zero daily effort. Trading violently plots top left, delivering results in minutes, requiring obsessive attention and maximum stress. This choice dictates the rhythm of your daily life. You are deciding exactly how much time and sanity you are willing to spend for every rupee the market returns. Let's step away from the charts and imagine a guy named Badhu Rao. He runs a mobile phone shop in a highly competitive market. Every morning, he goes out, buys phones at a wholesale discount, and flips them at his shop by the afternoon for a small profit margin. This works, but Badhu Rao can't take a day off. He has to track local demand, monitor competitors, and sell immediately before prices drop. But then Badhu Rao hears about a global microchip shortage. Instead of flipping phones daily, he buys a massive batch of inventory and locks it in a warehouse for 6 months. He doesn't look for daily buyers. As phones become scarce, his inventory multiplies in value without him lifting a finger. This is the market in a nutshell. Traders are the shopkeepers flipping shares for daily margins, while investors buy pieces of strong businesses to hold for years. Time is the ultimate separator. Trading is active, daily labor. Investing uses time to do the heavy lifting for you. To see the difference in effort, we can compare the actual inputs and outcomes of both paths side by side. With investing, the work happens up front. You conduct fundamental analysis, evaluating a company's business model, its leadership, and its long-term capacity to grow. Once the research is done and you've bought the stock, your job is basically over. You hold the asset passively, checking in a few times a year. Trading flips that script, ignoring the business to run technical analysis on price charts. Let's look at capital and returns. Investing requires larger capital over decades, yielding compound growth and dividends. Trading starts with small capital, using volatility to chase immediate gains. Investing scales your money through patience. Trading is an attempt to scale money through intense, daily analytical labor. But chasing those quick returns comes with a cost. The moment you start trading actively, hidden frictions begin to drag down your net profit. Every trade has a broker fee. Making dozens of transactions weekly continuously slices away your bottom line. Then there's the tax. Short-term trading profits are hit with roughly a 28% rate. Suddenly, a massive win is reduced to a tiny sliver. Trading is a zero-sum game. For you to win, someone else has to lose. But the broker and the government take their cut regardless of who comes out on top. These frictions create a brutal reality. Statistics show 90% of beginners lose their entire trading capital within their first 90 days. Long-term investors avoid this churn. With minimal brokerage fees and a lower tax rate of around 20%, more of the profit stays in your pocket. The active trading system is structurally designed to extract fees from you. For an amateur, surviving those constant leaks is mathematically difficult. Beyond the math, the heaviest cost of trading is psychological. It shows up in your nervous system, not just your spreadsheet. Traders live in an emotional loop. Immediate feedback creates extreme mood swings. Your heart rate spikes with every green candle, and anxiety sets in when the price drops. An investor's job is the opposite, to completely ignore the daily noise of the market. The trade-off for an investor is discipline. They have to watch their portfolio decline for months or even years without panicking or selling. Trading taxes your sanity daily, while investing only occasionally tests your emotional patience. Let's map this to your life. Follow this decision tree to find your ideal strategy, starting with one question: are you an absolute beginner? If the answer is yes, your path is strictly investing. Trading on day one will likely wipe out your account. Start by learning to buy stocks for long-term delivery. If you aren't a beginner, ask yourself, Are you a salaried professional with a day job and limited screen time? Salaried professionals should focus on passive wealth through mutual funds or fundamental stocks. Don't add trading stress to an already busy life. Only if you have market experience, abundant free time, and capital you can afford to lose should you proceed to active trading. Choosing the wrong path for your life situation is the fastest way to lose both your money and your peace of mind. If you are a beginner, treat your first year as an observational study. Buy a few shares in delivery mode for the long term. You need to learn how market fluctuations actually feel before you put more at risk. To protect your starting capital, choose a beginner-friendly platform like Angel One that won't drain your account with maintenance fees. If you eventually decide to try active trading, move to a robust platform like Zerodha or Upstocks. You need a system that won't crash during a time-sensitive trade. But the golden rule remains: never transition to trading until you are using money you can comfortably afford to lose. The stock market is a powerful wealth-building tool, but only if you align your strategy with your reality. Start slow, protect your capital, and let time do the heavy lifting.